private equity's role in healthcare and how might you benefit? So, either as an investor or as a recipient, this is going to be interesting to you. This 4.7 trillion industry is ripe for disruption. And this has caught the attention of those with money to put to work. Private equity has been tainted by things like flipping short-term approaches to long-term challenges and for making a bunch of money, which they have. But is there a role for this funding option? As much disparaging remarks as we make about it, let's take a balanced look and see what we can do to benefit from funding operations. So you're going to learn 5 things in the next 45 minutes. Positive and negative aspects of the various aspects of outside funding. Should you consider private equity or other private investors? When is bigger better? And if you are interested in it to grow your company, really, how's that going to work out? Number 4, have private equity short-term financial incentives damaged American healthcare? Lastly, is it realistic to believe that consolidation will deliver on the promised efficiencies? Maybe not. We're going to talk about that. So welcome to this month's Medville Lyceum. I'm Jim Trouson, the mayor of this little healthcare town. And here we invite our citizens and friends to gather to learn about a topic that would help them to deliver better health to their communities. We stole the idea from another town. Ancient Greece offered, or Athens, I should say, offered lyceums to their citizens. Presenters like Aristotle would share ideas worth their considerations. We do the same. So our guest today is Mike Ferkovic. Mike is a Medvillista in our Humbleistas Club. He graduated from Notre Dame, stayed there to get a master's in accountancy. Mike has 15 years of public accounting experience with Big Fours like Price Waterhouse Coopers, Deloitte. He recently left a private equity sponsored group of ophthalmology practices and surgery centers. There he led the M&A functions before being promoted to CFO. Mike has special expertise in strategic planning, helping those who want to buy or sell healthcare entities, turnarounds, and financial reporting. So, Mike, welcome. You've recently started your own firm, Physician CFO Solutions, and we're going to talk about that more later. Mike lives in the Cleveland area with his wife, Julie, and two daughters. So get to know him. He's been a very involved Medvillista, is helping us with our own financial reporting. So especially glad to have you here, Mike. And I want our other folks to know you as well as I'm getting to know you. So, Mike, you led a very popular breakout at our Akron barbecue about how to screen and manage potential partners if you're looking for outside investors. So let's get going here, Mike, for the next 45 minutes or so, and start off maybe with your experience with a private equity firm. You've become quite an expert at this that we've been tapping into. So why don't you tell us about your journey, Mike?
Sure. No, thanks, Jim. Good morning, everybody. Hope everyone's doing well and good to see a lot of familiar faces out here along the way. So my hope today is to expand on some of the things, either reiterating what we discussed at Akron, but also expanding upon it further. And I think one of the things that I would also emphasize too is as we get into the private session here too, I'm happy to speak. I'm not subject to any agreements or anything on what actually happened and why I'm here today along the way. So in order to talk about what I'm doing today, you also need to understand kind of the history of private equity and why some kid from Cleveland got eyes wide open and maybe was blinded by, at least in my experience, some of the glittering dollar signs I saw on the way here as well. So when we talked about the title for this Lyceum, I threw in there the concept of barbarians at the gate. So for those who have read or been in MBA school or just business readers along the way, that is a reference to a very popular book from the 80s and 90s, kind of standard reading when you're going to get your MBA for the management takeover of RJR Nabisco. So to understand the history of where we come from and why private equity has gotten so popular, that is a good example, not kind of pure play private equity as we think of it today, but the idea being that we're raising private capital via debt and via other investors, in this case, management, to be able to take over and restructure a company. That's what it was in the 80s. And then really, if we think about where we've come as a country economically since the 80s too, a whole bunch of things have happened. First and foremost, Cold War ended too. That has opened up an era of globalization, lower prices, when we think of manufacturing as well. Interest rates have come down too. So some of you guys know my father from Medville as well too. He always reminds me that their first mortgage was 17%. Me, I signed a 4.75 mortgage way back in 2010. I mean, it's just stark contrast. But when you have influences like that along the way, and debt, which is one of the core themes we'll talk about today, it can lead to more expansive, easier, to the extent you want it, more complicated financing. And so when we think about private equity, where it was in the 1980s and how I kind of got involved in it as well, it was truly coming from a pure play restructuring concept. How do we put as little money down now to, and we can talk about the formulas a little bit or even do an offline session, to increase our investment returns via the use of debt and other outside capital, to restructure businesses. And then here's the other core piece. So I talked about debt. You do have to sell these things at some point. So there are two givens when we talk about private equity, as I consider it. It's debt and then some timeline for a sale along the way. Now, a lot of what I'll talk about.
Well, and Mike, I think that's an important point to make. Is that how this story ends all the time? A sale, or
Yes,
the investors don't have any reason to do this?
correct. So at some point now, each fund or each investment may have a different investment horizon, and that's one of the key takeaways here as well. But you do have to sell the asset or the business, as I'll say, at some point. When it is up to the expectations of the investor and all the other correlating information that goes into making that investment along the way.
Well, and that's going to be a fairly short time frame, isn't it? That
Yeah.
your business is going to get sold in 2 years, 5 years?
It can. So let me make the distinction here too. So when I think of, and in my experience of private equity, it is committed capital funds. So that could be high net worth investors as defined by the Securities and Exchange Commission. There are rules around accredited investors too. We don't have to get into that today, but think of high net worth when you think of accredited. Going to committed funds. So what attracted me back in 2010, I was auditing Riverside Company and Blue Point and a bunch of private equity funds here in Cleveland. And conceptually, what they have done, and I bring up those names specifically because they have seen the full continuum since the 1980s. Their founders have worked through a bunch of different economic cycles, a bunch of different investment theses, and have raised a number of different funds, probably in the 20s, 40s, 50 overall, going to investors who are either high net worth and saying, hey, we have some ideas on how to put this capital to work. Would you commit, not actually write a check today, but commit to making an investment with us to the extent we find a target company? But that can also encompass the following, which is usually pension funds too. So here of OPERS or California State Pension Fund. Here in Ohio, the Teachers Fund will make investments that can include endowments. My university takes a significant position in private equity as they manage their endowment. And then it can include anything beyond that that is just defined as private capital too. So my experience and what I'm speaking to is more mature business investments, and we'll talk about the trend here from restructuring manufacturing companies to why healthcare in a second. But it can also, in a more broader sense, involve any kind of private capital investment. So to the extent anyone on this call has made an investment directly in a family or friend, very broadly, that is still private equity. Anyone experiencing venture seed funding, it's a different form of private equity as well. Now, we talked about it as well. Generally, that is going to include debt, and it's always going to include a sale because at some point you're going to want your money back too. And the question is at what return and over what timeline along the way. So let me kind of pause there, and then I can kind of jump into the experience with healthcare and why people are attacking healthcare through private equity in the last 10, 20 years.
Well, and Mike, I want to make sure that the people on this call get to know you better.
Sure.
So tell us about your experience at the private equity firm. Sure. And why you're not there anymore. Sure. What you're doing these days.
So let me draw the through line here and connect the dots here. So I graduated in 2008, did the traditional public accounting auditing, and I mentioned here I was auditing some of these private equity funds, and I went, holy cow. Luckily, I live in Cleveland. We have a tradition of private equity here too. I'm seeing some of the returns and some just the interesting investments in companies I had never heard of, including local companies that I hadn't seen before. So wind it forward. I'm a little bit slow in realizing that I just don't like auditing per se as it is in the current day and age. And I got into financial due diligence. So in 2015 or so, our small regional firm was bought by BDO USA. So it's just outside the big four of Deloitte, PwC, KPMG, and EY. And really, we had a nice little team of 4 to 5 guys that were doing buy and sell side financial diligence. All you need to know about that is if you've heard the term EBITDA, it's all about EBITDA. We're going through doing those calculations and assisting in the closing of these deals and the financing related to it as well. Had a ton of fun doing that. And I'll also note too, because we kind of flew under the radar being Clevelanders, that no one knew who the hell we were and why we even had an office in Cleveland. So we could kind of just keep going our own way here. But we had these connections to local private equity firms. And then our guy who had all the healthcare relationships too ended up leaving, starting his own thing. And I just kind of coyly raised my hand and said, I'll do the healthcare work. And we started growing it and growing it. So that really encompassed buy and sell side deals, all about EBITDA for dental, urgent care, ophthalmology, behavioral health, and you kind of go down the entire list here, just depending on who our client base was. In 2021, one of those clients actually called me and said, hey, my old boss is now with an ophthalmology roll-up in the Midwest. We had just had our first kid. It's in the middle of COVID. And I kissed my wife and said, I got to get out of the house. Can I go have dinner with this guy? I just thought it was a business development function as well. And so we went and did that. And what I found is my skepticism towards some of the private equity, just pure play roll-up plays we are going to acquire. We're not going to do a lot of integration, was kind of calmed by my dinner here. And we'll get into some of the details to the extent you guys want to hear it moving forward. And so what attracted me was we are going to integrate, high stress and high importance on integration, but also too, recognizing that within ophthalmology, you have retina, you have glaucoma, you have cataracts and everything underneath it as well, that each individual practice in some way needed its own strategic plan. So that piece of tailoring what our investment thesis was for each individual acquisition while trying to drive scale on the back end was really what got me on board. And we ended up closing. So I ended up joining that group, and we closed 13 deals over a 2-year period. These are.
And Mike, why did those doctors want to sell their souls in a sense, or why were they attracted to this model?
So a couple things. Each of them, and this is again tailoring the strategic plan too. Certainly, cash up front, it's pretty attractive too. It's very attractive. Part number 2, deferred cash. So the idea of rollover equity. Hey, we're going to buy 100% of your practice, but we're only going to give you 75% upfront. So you're going to pocket that, and then we're going to ask you to co-invest with us until we get you folks might have heard of a second or third bite too. So that eventual sale, theoretically at a higher valuation, because the theory here is that a group of practices carries a higher valuation than any individual practice on its own, could yield an additional investment return. What that is, kind of hard to define, but it's a selling point that I'm certainly at fault for, and that you'll often hear from some of these roll-up plays along the way.
Mhm.
But in terms of functionally, why did some of the doctors do it? One, succession planning. We don't need to worry about the succession plan. I've sold the practice, monetized it, and really the recruiting strategy and the replacement cultivation of the next leaders of that group would be shared, not just on the managing doctor or the group of doctors along the way. And then part 2 and 3 are gains in efficiencies too. We are sick of wrestling and contracting with our insurance company. We don't want to deal with the accounting. Our accounting's not that good. Our RCM and practice management system software is going to be incredibly expensive to implement and operate. We just don't want to deal with that. We just want to see patients. Or part number 3, which is we want to expand. We need capital to buy new equipment, recruit new providers, or build a new office along the way. Now, there's more than that too, but I would say those are the broad strokes in terms of why we did those deals. And I wouldn't say that those are any kind of exceptions. You will see that a lot beyond even ophthalmology. But if you've seen in the roll-ups of GI, radiology, kind of go down the list, there is an idea that there's more efficiency, which in turn will have some cost takeout, but you can also remove costs or increase revenue through better contracting or better vendor management along the way.
They might have gone to a hospital for some of that, but private equity seemed to be a better option.
They could. Now, this is all going to be relative to your individual communities as well. In our case, if you think about the Cleveland area overall, University Hospital certainly has an ophthalmology group, and it's all about relationships. Some of these guys wanted to go there, some of them didn't. Cleveland Clinic also has a very good ophthalmology group as well, and they have the Cole Eye Institute, which is a little bit more focused on research. For the guys that just wanted to practice, they didn't want to be associated necessarily with the research, or to the extent they had a relationship, said, hey, we're friendly with that group, but we just don't necessarily want to be economically tied together.
All right. Thank you.
Sure.
So a little bit more about your time there at Sunvera. Sunvera was the name of the company. And what led to you moving on?
So I mentioned one of the through lines here for healthcare and more broadly private equity too. It's the use of debt, right? So as we finance each of these deals, we had a certain target amount of debt that was higher than any of us just individually going to the bank to finance our own companies would be too. So it's an aggressive use of debt. All I'll say, just for simplicity here too, is the more debt you use, the potential for a higher return there is along the way. I can show you guys spreadsheets over along the way to show you how that kind of works, and we can share a slide deck that would articulate that as well. Now, when you do that and you don't drive the efficiencies that are promised, the question is, are those returns actually viable too? And I'll say just in this session, we can kind of get into it a little bit later too, is that in our case, the business, for a number of different reasons, took either a step backwards or held steady, depending on the practice, and then suddenly you have a debt problem. Now, that is not unusual too. So what I'll say is, debt gives you the upside of a very healthy return, but it also presents a significant risk because you got to pay that debt back in some way, shape, or form along the way. And it doesn't really matter which type of debt you use, mezzanine financing, there's a whole different session that we can get into the different types of debt. But at the end of the day, when you lend money, conceptually, you want to get paid back, and you want to get paid back at a reasonable rate of return as well. So that increased fixed cash flow out of the business rather than being able to be reinvested in the business. And I eventually looked at that and said, this is not the right fit. I don't think we've delivered on the promises we've kept here. And I'll fully raise my hand that a lot of that is my own fault. and said, hey, it's time to move on and use what I learned, hopefully in a what I believe to be a new manner, which is really just so what I'm doing right now to cut to the chase is really trying to help advise independent physicians on what their options are. So I'll put it this way. Some physicians want to sell, and that's a good thing, and we can kind of step through the process. But who also needs to sell? And that is a very different thesis along the way. So one of the key takeaways that I'll post for everybody here along the way is whether you're a physician group, whether a hospital group, whether you're a services group along the way, um, you should not rule out private equity. So everything I just said and everything you might read here along the way has painted private equity in, unfortunately, a poor instance. Now, there are some bad stories. They're real. I don't think we should deny those things. But there's also been some really good success stories. And in my mind, the differentiator here is those who attack private equity directionally with their own strategy. So just very simple, we have a very strong core strategy that your company, my company, believes in. And in some way, private equity bringing in private capital because they're really darn good at something that you're not good at or that you don't want to invest the time or resource into. Sales cycle, contracting, vendor management, the ability to recruit staff for new physicians, a proven track record on that along the way, then it might make a heck of a lot of sense. If you're an investor in private equity, there's no doubt it has worked and it has now worked for 30 years. It's not going away. Even if interest rates rise, whatever happens in the economy too, there are a heck of a lot of opportunities to make some pretty great returns as an investor. I would just sidebar it here too. You should talk to your financial advisor and make sure it's part of a whole plan as well. Just don't go say, hey, Mike told you to go invest all your savings in private equity. That would be silly. But you need to weigh these considerations and figure out how it fits for you. So when I say, do you need to sell? What I'm implying there is you've run out of other options. There's nothing else to do other than say, hey, my only choice here is I got to sell to this other group. If you want to sell, what I'm implying is that it is a fit for you. You see alignment with the group that you're bringing in, whether it's just a group of individual investors or I'm broadly speaking to in terms of a committed fund. But you should also get to know who that fund is. You can ask a ton of questions, and I don't see a lot of people actually doing that as well. What is their investment thesis? And so just some blocking and tackling items. What is their expected rate of return and how are they going to get there too? Use of debt versus equity. What are they going to actually bring to the table along the way? So what resources are they going to provide you? And frankly, what's the cost of that too? They will charge a fee for you. A management fee is usually what it's called. And that will take money out of your business. So nothing's for free. And then what's the sale timeline too? So if the sale timeline for them might align with you and the average private equity hold period in terms of how I'm thinking about it is 4 to 7 years, then it might be a fit. If you want to sell 10, 15, 20 years from now, then you need to go find the funds that are investing in there too. And I would say more broadly, the longer term funds usually tend to be family offices or individual and direct investments that say, hey, we don't have a need to return this capital to our investors over that shorter period of time. We really can work with you over a much, much longer period as well. So the work that I'm doing more directly is just out on my own, trying to help physicians evaluate their options on these things, mainly through financial modeling, because that's my background. But I would say as we kind of look ahead to 2025 and beyond, whether it's a hospital, whether it's a physician group, whether it's anything in between, a lot of private equity firms need to either do two things. One, put capital at play. So they have a large swaths of money that people have committed to them over a period of time that they say, hey, we need to go find investments for these people. Or they're in investments like the one I was with as well, and more broadly, that they need to exit those investments because they're butting up against certain time periods of either promised returns to investors, or there's something called a fund life that says, hey, we need to return all of your capital after 10 to 15 years as well. So I can step through a lot of different details as well. That was kind of drinking from the fire hose in terms of some of the concepts, but happy to kind of break that down. But we'll kind of turn it over to you, Jim, too, if there's certain questions that you want me to answer more directly.
Mike, we have some hospital people on the
Mhm.
call here, and so I suppose at some level this applies to them as well. Uh, However, there's some data now that shows that private hospitals, or those that are funded in large part by outside capital, aren't performing as well in terms of patient satisfaction, physician satisfaction. So I don't know if you got any thoughts about that. And then it leads to um, the question of is bigger better, really?
Yes.
Uh, and so many people, entities, hospitals, private practices that are going that route are doing it to fund growth.
Yes.
And do they really want to be bigger? uh,
Right.
that seems to be the holy grail. But how's that playing out?
So if you guys haven't picked up on this already, too, the answer to a lot of these questions is a maybe, right? So I'm not trying to be a politician on this as well, too, but it's about finding fit. So let's take a step backward, Jim. I mentioned some of the history of private equity has been focused on just simply restructuring the businesses that they invest in, too. Why is private equity, whichever way you want to cut it, looking at healthcare? They view it as a very disaggregated business where there's a lot of inefficiencies, and yet regardless of the headwinds all of us face every day to day, they generally cash flow pretty well too. So let's throw out the last couple of years here too, because we know some of the hospitals and physician groups have run operating losses along the way. Generally, up to that point, these were profitable, but the profitability tended to be declining, and there was needing to be help, hence bringing in outside capital to drive efficiencies in order to right size whatever the earnings might be, again, to investor expectations, whether that was constituency of your community, if you're a nonprofit hospital, if you did have outside investment as a for-profit for hospital, and so on, or frankly, if you're just an individual position not making as much as you once did or that you wanted to along the way. So let's think about, is the bigger, better question, is that relevant here along the way? So part of the private equity model tends to be we're going to drive efficiency. So that's organic growth. We're going to look at the investment we just made. And in the case of healthcare, and particularly third-party payer, better insurance contracting, seeing more patients, profitability of each of those patients as well. So can we drive better use of labor, which generally implies either more efficient use or less use of labor to provide that care, or better contracting with our vendors too. So the Cleveland Clinic down the street is really good because they're the big boy in town here at strong arming their investors either for better pricing or better terms. And when I say terms, we're not going to pay in 45 days. They might go to them and negotiate 60, 75 days or so on, or a rebate. In the case of the groups we worked with, they didn't really have a lot of negotiating power. So that gets into that discussion of is bigger better? And of course, the answer, and I told you off the top of these comments here too, is maybe. Maybe. Again, it goes back to your strategic plan as well. If your goal is to get bigger, then, excuse my French here too, you better be damn sure that you are going to be able to deliver those efficiencies for the sake of being bigger. Because there's always trade-offs here too. So when you are bigger, what does that generally imply? There's more people, there's more bureaucracy. Probably all of us have friends who are healthcare attorneys who had to help us, structure around ASA fees and how do we work through CON rules and Stark and all those types of things. There's just more to wade through along the way. So the alternative could be, and we see this sometimes, I'll use concierge medicine as an example here too, is to say, hey, rather than getting bigger, because we're not quite sure if we're going to be able to deliver on some of these efficiencies well, let's get really, really small. So I'll point to the hedgehog concept that a lot of you guys are familiar with in Good to Great too. Let's get really, really narrow, really, really good at one thing that we know we can get paid for and drive profitability that way. And so what's the decision here? It's a strategic planning decision and an execution decision along the way. So as you kind of consider these things, think about your strategic plan. Do we want to be bigger, and why? Really why? And who is going to provide those services to drive the scale that we want and the efficiencies we want? And I'll also point out too, those resources don't necessarily have to be in-house too. So I'll pick on one of the typical playbooks for in the roll-up space for physician groups. It's the centralized revenue cycle. So in concept, that's really good. Hey, we're going to spread billing and everything that falls under it over a smaller number of people in a central location. But what that doesn't answer is, are those people using the right IT tools? Are they actually the right people to deliver that efficiency that you want? So can we actually hire, I'll pick on my hometown here too, in Cleveland, can we hire the best damn RCM people we can find? And if not, then you should consider what your alternatives are too. Should you work with an MSO? Should you work directly with a billing company? Is that going to be cheaper and better at the scale that you want and the size that you want along the way? Again, to deliver the profitability that you seek, or really in relation to, and this is the core piece with healthcare, the mission that you have along the way too. So that's where it gets difficulty here is we're all working for businesses. We all want to make a profit. I'll steal a line from an executive director at a nonprofit I used to work with too. There's no mission without margin. I'm sure he stole that from somebody along the way as well. But we're working in healthcare. At the end of the day, we're probably getting out of bed because we get excited about working with patients and driving better outcomes. So to circle back around and answer your question, Jim, on the statistics, I think you might share after this some of the stats and research that John Sullivan has provided on the hospital side, and I'll just show more broadly too. The quality outcomes are lacking. I don't think that surprises everybody here along the way. And so the question is, can we enforce or do we seek outside investment that aligns with that strategy that says, hey, we can both make a profit here at a healthy return according to whatever the sectors is. Okay, again, use of capital, debt versus equity, term, what types of investments are we making as well? But we are not going to let go of the quality part of that too. That's going to be a key part of our growth. Now, where we need to draw that through line, and I'm going to shout out Pam here too, because she brought it up in Akron too. I believe, and it just is going to take more effort, that we need to draw the through line that quality outcomes does deliver a return on investment. And if you can prove that, then that will determine if private equity survives here within healthcare in some way, shape, or form for the next 5, 10, 15 years and beyond.
Mike, Dr. Souza put a question in the chat that's thoughtful and provocative. Jim is a chief physician executive at a major network of hospitals. And here's what he said. My question is a follow the dollar one. I'd like to know what the impact of PE acquisitions is on the total cost of health delivery to the ultimate payer. The individuals of the U.S. is paid for by consumers covering the cost of the employer-based insurance or citizens paying their taxes. So any thoughts on, is this increasing the cost of healthcare for all of us, this movement of bringing in outside investors?
So it's a great question. I don't have a citation to give you the exact answers here too. I don't know that it's increasing the cost, but certainly not lowering the cost either. So I can say pretty confidently that that is the case there. And obviously it's a very complex issue of how you attribute some of these influences along the way. But I mean, it just as this group would kind of look around and share their own experiences, whether it's with their employer or with the impact of their family, costs are certainly not going down. And at some point, we should have seen that at this point, given that there is a track record, not only in hospitals, but physician groups and beyond these investments, because it's been going on 5 to 10 years. That's enough of a tail that we would have seen some effect at this point, and we've not.
Mm-hmm. Thank you. And to circle back to the 5 things we want you to take home is, so what's the impact on quality, the physician experience and the patient experience of outside investment?
So a couple things here too. One, I'm just going to speak to an anecdote, and second, I'm going to cite a private equity funded piece of research on physician groups that I recently saw. Jim, I think we should share those stats that John has researched too, which are pretty clearly lay out that there is a downside basically quality is deteriorating along the way. So a couple things. Anecdotally, I'm going to share a article I wrote next week. And the sense is, both from a physician standpoint, these are guys that we invested with or that I continue to talk to every single day outside of my work in ophthalmology, and they feel more pressure to simply see more patients too. So has the burden of administrative work lightened so they could either see more patients, assuming that's what they want to do? No, it is not. If anything, it's wading through more bureaucracy and again, not delivering the efficiencies that we had hoped for and promised to. There might be groups out there that did that. We just got to go find them along the way. Now, from a patient experience standpoint too, I'll cite the anecdote of a friend who went in to see just doctors that shall remain nameless as well. Should have been basically a 30 to 45-minute checkup. Ended up waiting there for hours to see the initial nurse, then primary care doctor. Ended up being there 3 hours for just a kind of blocking and tackling checkup. That is not unusual, and I would also note that's a sample size of one. But the sense was, and the reason the friend called me, because it was a private equity-owned group, was that it was private equity's fault. And at worst, we have a perception problem there too. So whether that was just a bad day at the office for the group of providers that she was seeing, or that was a worse attribution issue, that it was really driven by staffing issues and patient flow. Who knows if that was actually at the bequest of PE. We do have people making accusations out there. So that's part one. Part number two is one of my friends at a public accounting firm that is doing healthcare financial diligence, published on LinkedIn maybe a week or two ago, basically some outcomes that basically say a private equity owned group of physicians, a roll up, is driving more efficiency and quality outcomes and less cost to the consumer, the patient, than a hospital owned group too. So I didn't put it in LinkedIn because I don't want that stuff out there too. Send them a nice text and go, well, this is pretty clearly missing one key stat. Is it costing less and is it better quality outcome than independent groups? That's what I would want to know. If we're going to measure those two components against each other, then we should be fair and also measure the independent groups along the way. So some of this stuff is kind of fuzzy in terms of, in that case, some bias of what they were measuring. Who knows? Maybe there is helpful and it is doing some cost takeout. Obviously, I'm a little bit skeptical. Otherwise, I think they probably would have published that data along the way.
Okay, thanks, Mike. And we're about 5 minutes from going into our private group discussions about this. So Tiago's going to put up a satisfaction survey here for you. But in the meantime, Mike, if folks want to get a hold of you, how could they best do that?
So I think Tiago will share this in the chat as well, and you can certainly find it in our great chat GPT and our Teams meeting too. But it's first initial, last name, so M-F as in Frank, E-R-K-O-V-I-C at physiciancfo.solutions. No .com after that, it's .solutions. And you can email me and have a chat here too. And by the way, for anyone that's disagrees with me, I love that. I would really invite that conversation. We do it respectfully, and that's partially why I love MedVale here too, is we can have a healthy debate on what the outcomes are.